Hey guys, welcome back. Today we are going to solve a problem which is from business restructuring conversion problem. Here what we are converting? We are converting the firm to company. So the provision what we have to know is for a firm which is converting to a company, there are four conditions to be satisfied to make the transfer uh, which is no not attracting capital gain, right? What are the four conditions is all assets and liabilities should be transferred completely to the company. The second condition is uh, the partners in the firm shall become shareholders in the company in the equal proportion in which they have actually held the capital in the firm. Okay, in proportion of capital they will be holding the shares. Okay, then the partners has to hold more than 50 percentage of ho- more than 15 percentage of voting power and 5-year locking period. Okay, and the last one is the consideration should not be money or anything, it should be the shares shall be shares only. So these are the condition. If these conditions are satisfied, the transfer won't attract capital gains. Otherwise, it will attract capital gain. Okay, right? Okay, yes, we have understood it. In this problem, what we are going to see, we'll just read the problem here. ABC Limited converted into a company, right? Balance sheet they have given. A is capital, B is capital, C is capital. So these are all the this is the firm's balance sheet. They have machinery which is WD value has been given. Investments also we have stock debtors bank they have given. Okay, and machinery has become how much? 1,25,000, 1,20,000 when they are converting. They are converting at the uh, converting more than book value. Investments they are converting it to while converting they are valuing it as 2,50,000 and the stock 90,000. Okay, and then others are similar only. Okay, bank will be same as it is. There won't be no value increase or decrease in that. So what they're asked us to do is the firm fulfilled all the conditions. The firm has completed all the four conditions. Okay, the partners account are settled by way of issuing equity shares. Okay, the partners accounts are settled with equity shares. See, okay, in the proportion of the capital ratio that I have already said in the conditions. Okay, however, on first 4 2025, all partners are transferred all their shares. Okay, the condition or the timeline will prepare 31st 12 24, date of conversion, year and 31 3 25. Okay, when they are actually transferring all partners are transferring shares, the violation happens 1 4 25. Violation occurs. If violation occurs means we have to the exemption provided for capital gain, no, that has to be reverted back. The exemption withdrawal will happen. How? That's what we are going to see here. Okay, Yes, this is the actual timeline, and the machinery investments and the stock. The machinery investments are so which are all the depreciable assets here? This is depreciable. Investments are not depreciable. If depreciable means section 50, non-depreciable means section 48. Right. Okay. Stock. This is PGBP. All other things we can slowly take it forward. Right. Okay. Now, so we have only one, which is one depreciable asset, one non-depreciable asset. No, section 50, section 48. So we have to consider we have to calculate the capital gains. Sale consideration minus transfer expense. We'll get the net sale consideration minus cost of acquisition. Okay, or indexed cost of acquisition minus cost of improvement minus hyphen indexed cost of improvement. Track that will get gross LTCG minus exemptions will get net LTCG. Okay, this is the LTCG that we have to tax. We have to add as the deemed income for the company in the successor hands. Okay, in the successor means in the company hands. The company is the firm is converted to company. No, the company hands this LTCG will be taxed. Right. Okay, what's the sale consideration for section 50? Section 50 deals with the depreciable. This is non-dep. Okay, machinery is depreciable asset. What they have transferred for 1,20,000? No transfer expenses. What's the cost? What's the cost of acquisition of machine, which is 1 lakh? Okay, there is no cost of improvement. 20,000 is the gross LTCG. That's the net LTCG also, right? Then sale consideration is 250 lakhs for the investments. There is no transfer cost. 2,50,000 directly comes. And then what's the cost of acquisition? Here, is there a possible of indexed cost of acquisition? See, the date of transfer is 31st 12 24. If it is before 23 7 24 means there is a chance that there is not a chance that we have to calculate the indexed cost of acquisition, but this occurrence is after 23rd 7 2024, so we don't need to calculate any indexation, so directly we can do that. How much is the cost of acquisition, which is 50,000, which in case of WDV, right? Okay, no improvement, 2 lakh goes that we have 2 lakhs as the LTCG. So total deemed income will be deemed LTCG will be 2,20,000 in the hands of company, and also the company as transferred these stocks no beyond 70,000, which is additionally they have charged 20,000. This is actually the PGBP income you have to consider, and this is tax standard PGBP. So this is how we have to solve a problem, and we have to write a note for everything. So for all the procedures, why do we need to take this consideration like this? Why do we need to calculate like this? That all these things we have to do. If that everything is set, the problem will be the short one more problem. Okay, thank you.